Okay, so I am going to try to use this video as an example of basically how taxes work. I get this question a lot. S corps flow into individual taxes, so I am going to try to draw this and explain it as we do it. This is just a very general overview. So, sorry, it's allergy season right now, so I have a little bit of a scratchy throat. Okay, so first you have your S corp over in one area. So we have this S corp here, and let's say this S corp has, after we throw in all the expenses and everything, the S corp has $100,000 of taxable income. Okay, so that's what we then file an S corp tax return, and we file it to the IRS. So this is what's filed. Every state's different, cities are different, so we're not really talking about local and state taxes, we're talking about federal taxes. And at the federal tax level, you do not owe any taxes under an S corporation. So what happens is this $100,000 then flows to your 1040, otherwise known as your individual tax return. Okay, so we got the 1040 here, and we've got this income pops over to your 1040. So we have $100,000 reported as income on your 1040. Then, if you have any other streams of income, that's also thrown into there. So, like a W-2 goes into there. Rentals would go into there, and all that kind of stuff. So, or stocks and dividends would go in there as well. So pretty much all your income streams get dumped into this one bucket called income. Alright. We have our income bucket right here. And let's say after we throw in our $100,000 of income from the S Corp, and we throw in some W-2, some rent, some stocks, long-term capital gains and everything, basically we have this income bucket, and let's say we have $200K. Alright. $200,000 of income. Then there's a few deductions. We might have a business deduction called QBI, Qualified Business Income Deduction, and we probably have a standard deduction. Depending on whether you're married, single, the standard deduction is going to be different, but we're going to pretend like this is a single person, so we're going to claim about $13K deduction here. And the QBI is really about 20% of your business income, so that's going to be about a $20,000 deduction. So then that gives us taxable income of, doing some quick math here, of about $167K. Where'd my mouse go? Okay, $167K. All right. Then we say, okay, what are your tax brackets? And so the tax brackets are kind of a complicated thing, but basically the first $10,000 is tax-free, or at a very, because of this $13,000 standard deduction. Then above that, the next $10,000 is at like a 10% bracket, and then it slowly progresses from there. And the next $10,000 is at a 12% bracket. And then it slowly increases all the way up to, like, let's say you hit about $300,000 and you're now in the 40% tax bracket. So the tax bracket system is a progressive system, so that at lower amounts of earnings you have less pain. And then as you make more money, the amount of tax that you pay then increases your pain, basically. The more money you make, the more taxes you pay. And so we have two different tax rates. We have the progressive tax system that falls into our tax brackets. So you might fall into a 30% tax bracket, which is actually about where this 167K is. We're probably looking at about I don't have the tax brackets in front of me, and they adjust for inflation every year, so it really changes quite often. But at 167K of taxable income, we're probably looking at about the 30% tax bracket. But because of all those lower tax brackets that you're utilizing, the 10, 12, 15, 20, 24, and 30 brackets, we then also have the average tax rate of your entire income. And so we could calculate your average tax rate based off of the total income of $200,000, or we could base it off of this one, the $167,000 taxable income. And we call that your effective tax rate. So you have your tax bracket, and then you have your effective tax rate, which is just the average of all the brackets based on your income. So this will sit at about a 20% average rate, or effective rate. So we're going to say approximately 20% is your effective tax rate. So that means on $167,000, times that by 20%, you're going to owe about $33,000 in tax. All right. Then what's going to happen is we're going to say, okay, well, you had some income tax withholding on W-2s, or you made quarterly estimated tax payments throughout the year. So we're going to say, let's say you just happen to have $10,000 in income tax payments that happen throughout the year. So then we're going to say, oh, all right, you owe $23,000 in tax. That's what you owe the IRS. Now, there's going to be some other things at play there, but this is the basic concept of what is going on. And so, like, I have a lot of people ask, well, how much taxes did my S-Corp cause? Well, that's really hard to say, because it all got dumped into this bucket right here with everything else. And because of that, this is where everything is. And then, so there's multiple ways we could calculate that to answer that question. Like, if I go to court, I have to break out, like in a divorce proceeding or something where we have to say, well, how much did this particular entity cause in taxes? I could calculate that multiple ways and come up with correct answers, and they're all going to be significantly different. I could just say, well, what's 20% of $100,000? That's how much taxes this costs. And that's usually the easiest way. That's the back of the napkin, quick answer, right? But really what's happening is this $100,000 got broken up equally based on total income, so it's all percentages and allocations, and I should be breaking this $100,000 between each bracket at the different tax rates to actually get you that correct answer. And so it's very complicated to come up with that. And the only time I actually do that calculation would be like in a divorce proceeding or something like that, where they're trying to divvy up who owes what taxes. But that's really it. So quick number is, well, your S-Corp cost you 20% in taxes. But that's not the correct answer. It's just the back of the napkin. But this is kind of a general overview how everything works and flows together to show you how much tax you owe. So really, the 1040, there's not a whole lot we can do on the 1040. All the work is done in the S-Corp, coming up with what is this $100,000? How do we calculate that? And that's when we start taking into account, okay, total revenue. Let's say you made like $200,000 in revenue. We throw in your general operating expenses, and then we start coming up with those personal expenses that you're already paying money for that we then push into the S-Corp as a business expense, like your home office deduction, your vehicle, your cell phone, your health and wellness plans, like your gym membership and your health insurance and your out-of-pocket medical expenses. And depending on what type of industry you're in, that could include groceries, that could include social media advertising and makeup and being your own model and stuff like that. Or that could include cost of goods sold if you're into retail. There's all sorts of things that go into the expenses that we're able to take into this. But this is the general idea of how the taxes work. I'm going to start using this to forward to people when they ask this question. If you have additional questions after reviewing this quick 10-minute video, then you can shoot me your questions in email format. All right. Thank you.